Good day. Today we will tackle about the asset management efficiency and liquidity.
Asset management ratio measures the efficiency with which the firm uses its assets to produce sales. There are common ratios. First is inventory turnover. Inventory turnover is a ratio that measures the number of times inventory is sold or consumed in a given time period, also known as inventory turns or stock turn and stock turnover. The inventory turnover formula is calculated by dividing the cost of goods sold by average inventory.
First, the represents the number of times inventory is sold and replaced. The formula given is inventory turnover is equal to cost of goods sold or COGS over beginning inventory plus ending inventory over 2. Example, we have Company A. Company A has the cost of goods sold 250,000. The beginning inventory is 35,000. Ending inventory is 15,000. So inventory turnover is equal to 250,000 since the cost of goods sold is 250 over the beginning inventory 35,000 plus the ending inventory 15,000 over 2. We have 250,000 over 50 over 2. So 250 divide 25. 25 from 50,000 divide 2. Then we have the answer 10 times. Meaning 10 times sold and replaced.
The next is age inventory. Age inventory is basically the product which are either slow moving and in very low demand or barely sell at all. The formula is age of inventory equals 365 days over inventory's turnover.
Example, we will calculate the days of inventory sits in the warehouse. Since the inventory's turnover is 10 times, age of inventory is equal to 365 days over 10 times. So we need to divide the 365 days over 10 times is equal to 36.5 days. The inventory sits in the warehouse.
Receivables turnover, net sale revenue, and average net ER once high number. The accounts receivable turnover ratio measures a company's effectiveness in collecting its receivables or money owned by clients. The ratio shows how well a company uses and manages the credit it extends to customers and how quickly that short-term debt is collected or being paid. Also measures how many times average company collects its receivables during the year. And how to calculate accounts receivable turnover? To calculate the accounts receivable turnover, divide the net value of credit sales during a given period by the average account receivables during the same period. An average for your accounts receivable can be calculated by adding the value of the accounts receivable at the beginning and end of the accounting period and dividing it by 2. The formula of accounts receivable turnover ratio. Accounts receivable turnover equals total supplier purchase over average accounts payable.
The next is asset turnover. Asset turnover measures the value of a company's sales or revenues relative to the value of its assets. The formula is asset turnover equals the net sales over total asset. For example,
How will the firm can generate sales using its assets? Example, company A has the net sales of 900. The total assets is equal to 450. So asset turnover is equal to 900 over 450. So we need to divide the 900 and the 450. So we get the answer 2 times. That's the firm can generate sales using its asset. The next topic is liquidity ratio. It is the ability to convert assets into cash quickly and cheaply. This is the most useful when they use it in terms of comparative forms. It could be internal or external. This is the availability of liquid assets to a market or a company, a high volume of activity in a market. In business, it's determined by how quickly a business can convert its assets into cash. Non-cash assets in this context could include stocks, equipment, and money owned by the debtors. But individual businesses may hold different assets depending on their industry and business type. In financial, it is the simplicity with which any asset can be converted into ready cash, either to spend or to invest. The lower the price fluctuation in a quick sale of an asset, the more liquid the asset. The common formula used in this topic is net working capital is equal to current asset less current liabilities. In current ratio, we have current ratio is equal to current asset over current liabilities. In quick ratio, also known as acid test, is equal to current assets less inventory over current liabilities. Example, for getting the net working capital, we have net working capital is equal to current asset less current liabilities. Since in this financial statement, we have the current asset 1,600,000, and then the current liabilities we have 1,200,000. So we need to have 1,600,000 less 1,200,000 is equal to 400,000. So that's the total of net working capital. So next is the current ratio. Current ratio is equal to current asset divide to current liabilities. So we have the current asset 1,600,000 over the current liabilities 1,200,000. So we get the answer of current ratio 1.33. Next is quick ratio, also known as acid test, is equal to current asset less inventory over current liabilities. So we have the current asset 1,600,000 less the inventory 600,000 over current liabilities. So 1,600,000 less 600,000 is equal to 1 million over 1 million. So 1 million over 1,200,000, since the current liabilities is 1,200,000. So we get the answer 0.83. So that's the quick ratio, also known as